Welcome once again. This is part 2 of the lecture we initially had on financial accounting. So today we are going to be talking about assets and liabilities. We are going to be talking about capital and revenue expenditure and any other important issues. So first of all, let's understand what an asset is. What is an asset? An asset is a resource that is controlled by the business that yields future economic benefits. That's an asset. So when we say an asset, in English, basically, when we say an asset, something that is valuable. In accounting, it's, a resource that is controlled by the firm that yields the firm future economic benefits. Very, very important. So assets are classified into two. You have non-current assets and you have current assets. So non-current assets are basically assets that are held in operations for a long time that are intended to help generate profits. So by long time, we mean more than a year. When you hear long time, it means more than a year. So things like office building, plant and machinery, furniture, all those things are non-current assets. They are non-current assets. And you also have current assets. Current assets are held for only a short time with the intention of just turning them into cash, for your business. So, like I said, when you hear short time, it means within a year. Within a year. In accounting parlance or accounting language, it means within a year. For a long time, it means over a year. Over a year. Over a year. So non-current assets are held and used in operations for a long period of time to generate profits. Current assets are held only for a short time with the intention of turning them into cash for the business. So an example of a non-current asset, like we said, is office building, plant and machinery, etc. An example of a current asset is stock or inventory, receivables or debtors, people who owe you. Those are current assets because you can easily convert that to cash quite easily than let's say plant and machinery, which is a lot more fixed and non-current in nature. Then let's talk about liabilities. A liability is something which you owe someone else. So these are your financial obligations. These are your debt obligations. That's what a liability is all about. Liability is simply the accounting term for the amount a business owes other people. So please keep that in mind. So liabilities too has two classifications. You have non-current liabilities and current liabilities. Non-current liabilities and current liabilities. So what are non-current liabilities? What are they? When we say non-current liabilities, they're also known as long-term liabilities. And these are obligations that are listed on our statement of financial position that are not due for more than a year. They are not due for more than a year. So a typical example will be a long-term loan which lasts for 5 years. So these are not due for more than a year, or their lifespan is more than a year. Always remember the 1 year threshold that differentiates between short time and a long time. Then you have current liabilities. These are company short-term financial obligations that are due within 1 year. Remember, short-term means 1 year in these definitions. Long-term means more than 1 year. So a typical example will be trade payables. Very, very important to understand. So that's assets and liabilities in a nutshell. It's very, very simple. So once you have this understanding, you can then delve more into the accounting equation. You remember that in our past lecture, we defined capital. We said capital is a special form of liability. It's a special form of liability which represents the amount the business owes to the owners. Because when the owners start a business with capital, it's like they put their money into the business, right? And so the business owes them. It's like the business has borrowed money from them. So the business owes them. So that's why it's a special form of liability. Remember, we talked about the entity concept where we said the business is different from the owner. So if I'm the owner and I'm putting money into my business, it's like the business is borrowing the money from me. That's why it's a special form of liability. So in the accounting equation, assets is equal to capital plus liabilities. A is equal to C plus L. Please don't forget this. This is the basis of accounting. Assets is equal to capital plus liabilities. Assets is equal to capital plus liabilities. Very, very important. Please keep that in mind. Your asset is always equal. That's why this is what makes the balance sheet balance, or your statement of financial position balance. Your assets must always be equal to your capital and your liabilities. So let's look at a comprehensive question. Right? We want to attempt this question. It says, prepare a statement of financial position for Ted Hill's hardware store as at 31st December 2006, given the information below. You have capital as at January 2006, 47,600. You have profit for the year, 31st December 2006, you have 8,000. You have freehold premises, net book value at 31st December 2006, 50,000. You have motor vehicles, 9,000. Fixtures and fittings, 8,000. Long-term loan, 25,000. Bank overdraft, 2,000. Goods held in inventory for resale, 16,000. Receivables, 500. Cash in hand, 100. Payables, 1,002. Taxation payable, 3,500. Drawings. Drawings are simply money that the owners take out of the business. Drawings, 4,000. Accrued costs of rent, 600. Prepayment of insurance, 300. And it says a shop might have cash in its cash registers, but an overdraft at the bank. That's a small note. So let's prepare the statement of financial position. Always remember that assets must equal liability. So let's identify the assets here. First, we need to divide it into non-current and current assets. So always start with non-current assets. Very, very crucial. Always start with non-current assets. So for non-current assets, you have the first non-current asset you should be thinking about is freehold premises. So if you look here, you realize that freehold premises has a net book value at 31st December 2006. 31st December 2006, which is 50,000. Let me circle it so that you can see it right here. 31st December 2006 this year. So it's 50,000. 50,000. So that's our first asset, right? Our first asset. Our second asset will be motor vehicles, which is 9,000. Our second non-current assets. We are looking at non-current assets first. Then have your fixtures and fittings, which is at a net book value of 8,000. Fixtures and fittings, 8,000. So when we say net book value in accounting, every non-current asset has a cost. The cost of the assets. Then all non-current assets go through, not all of them. So all of them except for land goes through depreciation. So these non-current assets depreciate. So for example, if you have a motor vehicle, right, and you use it for some time, it will begin to depreciate. It will begin to experience wear and tear. It will begin to get old. And so if you take your cost and you minus depreciation from the cost, that's where you come to net book value. So net book value is simply cost minus accumulated depreciation. So these are your non-current assets: freehold premises, motor vehicles, fixtures and fittings. I hope that's clear. So you see, freehold premises, So you see freehold premises, you see 50,000, fixtures and fittings 8,000, motor vehicles 9,000. Then gives you a total of 67,000. 67,000. These are the non-current assets. Like I said, always start with non-current assets. Always start with non-current assets. The reason why you have to start with non-current assets is basically because of how the financial statements are presented. The non-current assets, like we said, more than a year, right? They are long-term in nature. So you start with the long-term stuff and you move on to the short-term items. You start with the long-term items, then you move on to the short-term items. Okay, so let's move on to current assets. Current assets. So what will be the current assets in the question? You start with, on the current assets, I can see current assets. An example will be inventory. Inventory. Yeah, so goods sales in inventory for resale, right here, 16,000. You have receivables as well. You have cash in hand as well. And you have prepayment. It's also a current asset. Anything you are prepaying is also a current asset. So goods held in inventory for resale, 16,000. Receivables. Receivables are your debtors. People owe you. They are also assets. Your cash, 100. And prepayment of insurance, 300. 300. So let's go back to the solution, see what's happening. Yes, let's go back to the solution. So you can see clearly from here that everything we mentioned, inventory, receivable, prepayment, cash, is all here. These are all as current assets. Current assets. Again, if you want to tell what is a current asset, you look at, the threshold, the 1-year threshold. All these items here are intended to be converted into cash within a year. These ones provide long-term benefits that extend beyond a year. So if you have a motor vehicle, you can use it for more than a year. If you have fixtures and fittings, more than a year. Premises, more than a year. But these items here are operational in nature and meet the 1-year threshold. So you see, these are the current assets. So if you add all these current assets, you get 16,900. Now you need to add the non-current assets to the current assets to get the total assets, which here is 83,900. 83,900. So these are your assets. Assets. Everything here you see here are your assets. These are your assets. Right, now let's move on to, we said the accounting equation is what? A is equal to C plus L. So let's move to C. Let's move to C. Let's move to C. It's getting very, very interesting here. Let's move to C. Let's move to C. So when we go back to the question, you would realize that you have to calculate your capital, right? To calculate your capital, you need your capital as at 1st January. As at 1st January, always remember that the statement of financial position is prepared as at what? The end of the year, 31st December 2006. But you have a beginning capital balance or an opening capital balance or a capital balance at the start of the year of 1st January 2006, which is the beginning of the year of 47,600. So what you need to do is you take this capital, which is the beginning balance, you add it to your profit. You add it to your profits right here. You see, you add it to your profit. And then you take out any drawings, because drawings is like a withdrawal from the business. So you come to drawings and take out any drawings, which is 4,000. So always remember this: the closing capital balance, closing capital is equal to your opening capital plus your profits, which is P, right, minus your drawings, which is D. Always remember this formula. Closing capital is what? Your opening capital plus your profits minus your drawings. So let's go back to the question. Let's go back to the solution, sorry. Let's go back to the solution and see what's happening. So if you come here, you see that exactly what we said. Exactly what we said. See, your capital at the beginning, which is 47,600 here. You have your profits in there, 8,000. And you have your drawings, 4,000. It gives you an ending capital balance of 51,600 right here. So then let's move on to non-current liabilities. So now we finished the capital side. So capital, you add your profits for the year and you take out your drawings. Then let's move on to the liability side. Now liabilities, we start with what? The long-term liabilities first. Always start with the long-term liabilities. So you have the non-current liabilities. Let's see if we have any non-current liabilities. Let's go back to the question. Non-current liabilities. A typical example of non-current liabilities is long-term loan, which is how much? 25,000. 25,000. If you go back to the question, you should see the solution. You should see 25,000. See, it's right here. 25,000. Nice. So it's shaping up very, very nicely. Then we move on to current liabilities. Current liabilities. These are your short-term liabilities. So let's go back and see exactly how we are going to approach this. Let's go back and see how we are going to approach this. So your current liabilities, right? First off, you need to know that payables is a current liability. Your accrued cost of rent is also a current liability. Your bank overdraft is a current liability. And your taxation payable is also a current liability. It's also a current liability. So if you go back to the solution, you should see those four things. You should see those four things. See bank overdraft payable, taxation payable, and accrued cost of rent. Accrued cost of rent. So let's go back to the question and look at the values again, just to be sure. You want to be sure. Yeah, so bank overdraft is how much? 2,000. Your payables is how much? 100. Your taxation payable, your payables is, I think, 1,002, if I'm right. Your taxation payable is 3,500. And your accrued cost of rent is 600. Very, very simple. So you go back to your question. You go back to your solution and you see 2,000, 1,002, 3,500, 600. Then what does that total? It totals 7,300. Now you need to add capital plus liabilities. So your capital was what? 51,600. Your non-current liability is how much? 25,000. And your current liability is how much? 73,000. Okay, so what would that come to? If you add 51,600 to 25,000, which is non-current liabilities, to your current liabilities of 7,300, you have 83,900. 83,900. And that would balance with your assets. You see, your assets is, let me circle it with the red so that you can see clearly. Your assets is how much? 83,900. That's it here. And your capital plus liabilities are how much? 83,900. So that's A is equal to C plus L. Assets is equal to capital plus liabilities. Asset is equal to capital plus liability. So if you look here, if you go back, that was what we were talking about. It's right here. Let me just show you so that you can understand what's up. You see, we talked about assets is equal to capital plus liabilities. So that's what we see in the statement of financial position. So I hope that's clear. I hope that's a comprehensive enough example for you to follow. Very, very key. Very, very key. Very, very key. So that's an interesting question to follow. And so in our next session, we'll be talking about the income statement. So if you haven't subscribed to this channel, please do so. Please stick and stay with me as we walk through this financial accounting journey. It's going to be amazing, and I'm going to break everything down for you to understand. Thank you and have a good day.